I'm going to tell you something most men in this game learn too late, and some never learn at all. The market does not pay you for being clever. It does not reward your opinions, your hopes, or your need to be right. It pays you only when you are aligned with what is actually happening on that tape. Have you noticed that yet, most fellows come into trading thinking the secret is in prediction? They sit there staring at charts like fortune tellers reading tea leaves. They ask, where will price go next? But that's the wrong question, and it always has been. The real question, the one nobody explains plainly, is this: what is the market doing right now, and am I positioned to profit from it? You see, the truth nobody explains is that trading is less about knowing and more about waiting. Waiting is the hardest work a trader ever does. Anyone can click a button. Anyone can feel excitement when the candles start moving. But can you sit on your hands when there is nothing to do? Can you watch opportunity pass because the setup is not quite right? That is where most accounts begin to bleed. In my day, and it hasn't changed one bit, the biggest losses did not come from ignorance. They came from impatience. A man sees a chart twitch, and suddenly he feels he must act. Why? Because doing nothing feels like missing out. But the market does not reward activity, it rewards accuracy. There is a difference, and it costs money to learn it. Now let's speak plainly about charts, because the chart is simply the footprint of money. Price moves because someone, somewhere, with real size, is doing business. When you read a chart correctly, you are not predicting the future. You are observing pressure. Are buyers in control? Are sellers leaning on the tape? The candles will tell you, if you stop trying to outsmart them. Too many traders decorate their screens with indicators the way a nervous man carries lucky charms. But tell me, if 10 indicators say buy, and price keeps falling, who is right? The answer is always price, always. Indicators can assist, but they must never replace your understanding of trend, momentum, and structure. Here is another truth most people don't like hearing. The market is designed to exploit your emotions. Not personally. The market doesn't know you exist, but mechanically. Fear makes you exit too soon. Hope makes you hold too long. Greed makes you oversize at the worst possible moment. Have you ever noticed how your biggest trades often come right before your biggest mistakes? A professional trader, the kind who survives year after year, builds something more important than a strategy. He builds emotional discipline tied directly to money management. Because the finest chart read in the world will still fail you if your position size is reckless. Let me put it to you simply. If you risk too much on one trade, the market will eventually remove you from the game. Not because your idea was wrong, but because your sizing was foolish. The market allows many small mistakes. It rarely forgives one large one. That is why the real work of trading happens before the trade is ever placed. You determine your risk. You determine your exit. You determine how much of your capital is exposed. By the time you click the button, the decision should already be made. Do you see how different that is from the way most people trade? Most traders improvise. Professionals prepare. Now, about wealth, and listen carefully here, trading is not a lottery ticket. It is a business of probabilities compounded over time. The man who approaches it looking for quick riches usually supplies liquidity to the man who treats it like a profession. Consistency is built through boring repetition of sound decisions. Small edges, properly managed, grow accounts. Wild swings of fortune usually shrink them. It is not glamorous, but it is dependable. Another thing nobody explains: being right feels good, but being profitable feels better. And the two do not always travel together. Sometimes the best trade is the one you cut quickly. Sometimes the best decision is to admit the market is not behaving as expected and step aside. Can you do that without arguing with the screen? The market has no interest in your pride. The tape does not care about your last winning streak. Every trade stands alone. When you study charts long enough, patterns begin to repeat. Not because history guarantees the future, but because human behavior rarely changes. Breakouts, consolidations, climactic moves. These are expressions of crowd psychology. Learn to read the behavior behind the bars, and the chart becomes less mysterious. But here is the quiet truth beneath it all. Even perfect chart reading will not save a trader who lacks patience and self-control. You must learn to sit through boredom. You must learn to accept small losses calmly. You must learn to press when conditions are truly favorable, not when you feel restless. That last point is where fortunes are made or missed. The big money is not in constant trading. It is incorrectly identifying the moments when the market is clearly leaning one way and having the conviction and the capital to participate properly. But conviction is not stubbornness. Many confuse the two. Conviction comes from evidence on the chart. Stubbornness comes from ego. Which one has been guiding your trades lately? A sound trader also understands the rhythm of the market. There are times when price trends cleanly, almost generously, and there are times when the market chops sideways and punishes everyone equally. The amateur trades both environments the same way. The professional adjusts or steps aside. Sometimes the most profitable position is cash. That may not sound exciting, but it is the truth few are willing to accept. Because deep down, many traders are not just seeking profit, they are seeking action. And the market is very efficient at charging tuition to those who trade for excitement. If you truly wish to grow your account steadily, you must begin thinking differently about time. Wealth in trading is built the same way trends are built. Gradually, unevenly, and with long periods of quiet between meaningful moves. Position sizing protects you more than prediction. Most traders come into this game believing the great secret is knowing where price will go next. They spend their nights studying patterns, memorizing indicators, and chasing the perfect entry. But the market has a way of humbling the man who believes prediction alone will save him. Tell me, how many times have you been right about direction and still lost money? You see, the cold truth is this: you can be wrong often and still survive. But you cannot survive being reckless with size. The market is a business of probabilities, and even the finest setup will fail from time to time. That is not a flaw in the method. That is the nature of speculation itself. What separates the professional from the hopeful amateur is not the accuracy of his crystal ball, but the respect he shows his capital before the trade is even placed. In my experience, the trader who risks too much on a single position is not trading. He is gambling with better vocabulary. He may speak of charts and setups, but his account tells the real story, because when the size is too large, the mind begins to behave differently. Have you noticed that? Suddenly every tick feels personal. Every small pullback feels like danger. The trader stops thinking clearly because the money at risk has exceeded his emotional tolerance. That is why position sizing is not merely mathematics. It is psychology in disguise. When your size is appropriate, you can observe the market calmly. You can allow the trade room to work. You can follow your plan without flinching at every candle. But when your size is too large, fear begins to whisper. You exit too soon. You hesitate to cut losses. You begin negotiating with the market instead of responding to it. And the market, being what it is, rarely shows mercy to a nervous trader. The great operators understood this well. They knew survival came first. Profits came second. Because the man who stays in the game long enough will eventually catch the right conditions. But the man who overbets early often removes himself before opportunity ever arrives. It is not the market that defeats him. It is his own sizing. Now consider the mathematics for a moment, because numbers have a way of clarifying what emotions try to hide. If you risk 5% of your account on each trade and encounter a normal losing streak, which every trader will, your capital begins to erode quickly. But if you risk 1% or less, the same losing streak becomes merely a temporary inconvenience. Which trader do you suppose sleeps better at night? The market rewards the man who can endure. Another thing worth understanding is this: proper sizing gives you the freedom to think in probabilities rather than in single outcomes. The amateur trader obsesses over whether this one trade will win. The seasoned trader thinks in series: 10 trades, 20 trades, 50 trades. He knows his edge, modest as it may be, will express itself over time if he manages risk properly. But that patience is impossible when each position carries the weight of the entire account. And let me ask you something plainly. Have you ever doubled your size after a loss, just to make it back faster? Most have, at least once. That is not strategy. That is emotion attempting to recover dignity through risk. The market has seen this behavior for generations, and it continues to collect from those who repeat it. There is also a quieter benefit to correct position sizing that few discuss. It keeps your mind clear enough to recognize when conditions truly favor aggression, because there are moments, rare but powerful, when the market moves with unusual clarity, trends strengthen, volume confirms, structure aligns. In those moments, the well-capitalized and disciplined trader can press intelligently. But the trader who has been swinging wildly before that moment often arrives depleted, both financially and emotionally. He has spent his ammunition too early. Proper sizing, then, is not about playing small forever. It is about preserving strength until the odds are genuinely favorable. It is about staying solvent long enough to recognize the difference between noise and opportunity. Many traders search endlessly for a perfect entry, believing that precision will compensate for poor risk control, but the market is not so easily impressed. A mediocre entry with sound sizing can survive and even prosper. A perfect entry with reckless size often ends in regret. If you truly wish to understand the deeper game, begin watching your size more closely than your signals. Notice how your behavior changes when the risk feels comfortable versus when it feels heavy. Notice how patience improves when your capital is protected. Notice how clearly the chart begins to speak when fear is no longer shouting in your ear. Price action always outranks indicators. That is a lesson written in the losses of countless traders who trusted the tool more than the tape. I have seen men build entire strategies around colored lines and mathematical formulas, yet somehow remain puzzled when price marched in the opposite direction. Tell me, if the market itself is speaking plainly through price, why would you listen to the echo instead of the voice? You must understand what an indicator really is. It is nothing more than a calculation derived from past price. That is all it has ever been. It does not know the future. It does not see the orders sitting in the book. It does not feel the pressure of large money stepping in or stepping out. It reacts after the fact. Price, on the other hand, is the fact. Many traders reverse this relationship without realizing it. They wait for an indicator to give permission, even when the chart is already showing its hand. The candles begin to trend cleanly, structure starts to build, momentum expands. Yet the trader hesitates because the indicator has not crossed the proper line. By the time it finally does, the move is half spent. Have you ever noticed how often that happens? The market moves first. Indicators follow, never the other way around. Now, I am not saying indicators are useless. Used properly, they can help measure momentum, volatility, or trend strength. But they must remain servants, not masters. The moment a trader begins to trust an indicator more than the raw behavior of price, he has quietly handed over his judgment to a formula that cannot think. Price action tells a story in real time. It shows you where buyers are willing to step in. It shows you where sellers are defending territory. It reveals hesitation, exhaustion, acceleration, all the emotions of the crowd expressed in movement. Indicators smooth this information, compress it, and often delay it. That smoothing may look neat on the screen, but the market is not neat. Let me put it plainly. If price is making higher highs and higher lows with expanding momentum, the trend is speaking clearly. If price is stalling at a level repeatedly, supply or demand is showing its hand. If volatility contracts into tight consolidation, the market is often preparing for expansion. These are observations drawn directly from behavior, not from decoration. The inexperienced trader often builds what I call indicator dependency. His chart fills with moving averages, oscillators, clouds, bands, each one promising clarity, but the more tools he adds, the less clearly he sees. Why? Because conflicting signals begin to appear. One indicator says buy. Another says sell, a third says wait, and the trader, instead of thinking independently, becomes frozen. The professional keeps his chart clean enough to read the footprints of money. There is also a psychological comfort in indicators that many do not admit. They create the illusion of certainty. A crossover feels official. An oversold reading feels precise. It gives the trader something to point at and say, "See, the system told me." But the market does not reward comfort. It rewards correct interpretation of real conditions. Have you ever taken a trade simply because an indicator flashed, even though something about the price looked weak? Most traders have, and more often than not, the market quickly teaches the same lesson again. Price was telling the truth all along. Another thing worth your attention is timing. Indicators, by their very design, lag behind price. They must, because they are calculated from previous movement. That lag is not always harmful, but it becomes dangerous when the trader treats the signal as if it were predictive. In fast markets, that delay can mean entering late and exiting later still. Price action, however, reflects the shift as it happens. You will notice that experienced traders often speak in terms of structure, support and resistance, trend progression, consolidation ranges, momentum shifts. These are not mystical ideas. They are simply ways of describing what price is doing. Once you train your eye to recognize these behaviors, the chart becomes less cluttered and far more honest. This does not mean you abandon every tool. It means you change the order of authority. First read the price. Then, if you wish, let an indicator confirm what you already suspect, but never allow the indicator to overrule clear price behavior. That is the quiet mistake that drains accounts slowly. There is also the matter of adaptability. Indicators are fixed formulas. The market is a living environment. Volatility expands and contracts. Trends strengthen and decay. Liquidity shifts from session to session. A trader who relies purely on mechanical signals often struggles when conditions change, because the formula does not adapt quickly. But the trader who reads price learns to sense these shifts early. He notices when breakouts begin to fail. He notices when pullbacks grow deeper. He notices when momentum fades. All of this appears in price before most indicators fully reflect it. And perhaps the most important point of all is this: trusting price keeps your attention where it belongs, on the behavior of the market itself, not on the comfort of your tools. Because at the end of the day, money does not move because of indicators. It moves because buyers and sellers are competing in real time. If you want to improve your trading, begin with a simple exercise. Strip your chart down to price and structure for a while. Watch how trends form. Watch how consolidations tighten. Watch how false breakouts behave. Ask yourself what the market is actually doing instead of what the indicator suggests it might do. Being profitable matters more than being right. That simple truth has humbled more traders than any market crash ever could, because deep down, most people come into trading with the wrong objective. They want validation. They want the satisfaction of calling the market correctly. They want to say, "I knew it." But the market does not pay you for being correct in theory. It pays you only when your account grows. Have you ever watched a trade go exactly your way after you already closed it for a small loss? Or worse, have you ever held stubbornly to a losing position just because you were certain your analysis was right? If so, then you have already met the quiet enemy of many capable traders, the need to be right. You must understand something early in this business. The market is not a courtroom, and your trades are not arguments to be won. Every position is simply a wager on probability. Sometimes the odds work in your favor. Sometimes they do not. The professional accepts this quickly. The amateur resists it and pays for the lesson. In my experience, the traders who struggle the most are often intelligent people who are used to being correct in other areas of life. They bring that same mindset into speculation, and it betrays them, because in trading, certainty is expensive. Flexibility is profitable. Let me put it plainly. If you cut a losing trade quickly, you may feel wrong in the moment. Your pride may take a small bruise, but your capital remains largely intact, and that gives you the ability to participate in the next opportunity. But if you cling to a losing position just to prove your original idea was sound, the market has a way of turning that small bruise into a deep wound. The tape does not negotiate with your ego. One of the most important habits a trader can build is the willingness to admit uncertainty early. When price begins to behave differently than expected, the professional pays attention. He does not argue. He does not widen stops out of hope. He does not double down to defend his opinion. He simply recognizes that the market is not confirming his thesis and adjusts accordingly. Have you noticed how difficult that feels at first? That discomfort is the sound of ego being challenged. But the trader who learns to separate identity from outcome gains a tremendous advantage. Each trade becomes just another business decision, not a personal judgment. Wins are handled calmly. Losses are handled quickly. The account begins to reflect discipline instead of emotion. There is another side to this truth that many overlook. Being too focused on being right can also cause traders to exit winning trades far too early. The moment the position shows profit, they rush to lock it in because they want to secure the feeling of success. But the larger gains in trading often come from allowing a good position to develop over time. You see the contradiction, don't you? They cut winners quickly to feel right. They hold losers stubbornly to avoid feeling wrong. That inversion quietly drains accounts month after month. The professional does the opposite. He cuts losses when they are small and manageable. He gives winning trades room to breathe when the market structure supports it. It sounds simple when spoken, but in practice it requires emotional control that most people underestimate. Another point worth your attention is that no strategy, none, produces a perfect win rate. Even the strongest methods encounter strings of losses. If your identity is tied to being right on every trade, those normal losing periods will push you toward poor decisions. You will hesitate on valid setups. You will override your rules. You will begin chasing certainty where none exists. But when your focus shifts to profitability over a series of trades, something changes. Losses become part of the cost of doing business. Wins are evaluated not by how clever the entry was, but by whether the trade followed your plan and produced positive expectancy over time. That is the mindset of a durable trader. It is also worth noting that the market often punishes obvious consensus. There are times when your analysis will look perfect on paper. The level is clean, the pattern is textbook, the indicators agree, and the trade will still fail. Not because your study was careless, but because the market environment shifted or larger money moved differently than expected. In those moments, the trader who must be right suffers twice, once financially and once emotionally. But the trader focused on profitability simply records the loss, keeps the risk contained, and waits for the next high-quality opportunity. Tell me honestly, which mindset keeps a man in the game longer? The goal in trading is not to win arguments with the chart. It is to manage risk, exploit favorable conditions when they appear, and compound capital steadily over time. Pride has no line item on the profit and loss statement. The market keeps no score of who predicted what correctly. It records only what was gained and what was lost. If you truly want to improve, begin observing your reactions after each trade. When you take a loss, do you feel the urge to immediately prove yourself right on the next one? When you take a win, do you exit too quickly just to secure the emotional victory? These small behaviors, repeated often enough, shape the entire trajectory of a trading career. Consistent wealth in trading grows from small, repeatable edges. That is not the kind of statement that excites the crowd, but it is the one that keeps professionals in the game year after year. Most newcomers arrive with the wrong picture in their heads. They imagine one great trade, one bold prediction, one dramatic move that changes everything. But the market rarely rewards that kind of thinking for long. Have you noticed how often the traders chasing home runs disappear quietly after a few months? The truth is far less glamorous. Durable success in speculation is built the same way a strong trend is built, step by step, pullback by pullback, with long stretches of quiet progress in between. A small edge, applied consistently with discipline and sound risk control, compounds in a way that surprises those who are patient enough to witness it. But patience is not a popular commodity in trading. Many traders abandon perfectly workable methods simply because the results feel too slow. They mistake steady growth for mediocrity. They compare their quiet equity curve to someone else's highlight reel and begin searching for something more exciting. That is usually the moment the trouble begins. You see, an edge in trading does not have to be spectacular. It only has to be positive and repeatable. if a method wins a little more than it loses, and if risk is controlled properly, the mathematics of compounding begin to work quietly in the background. But the trader must give that process time to unfold. Can you do that without constantly interfering? The market has a way of testing a man's commitment to his own rules. There will be stretches where the edge feels invisible, a few losses in a row, some choppy price action, a week or two where nothing seems to follow through. This is where many traders sabotage themselves. They abandon structure in search of immediate relief, not realizing that inconsistency destroys the very edge they are trying to build. Professionals understand something important: the edge expresses itself over a series of trades, not in any single outcome. That is why they think in batches, not in isolated moments. 10 trades, 20 trades, 50 trades. Over that sample size, a genuine edge begins to show its character. But only if it is applied consistently. Let me ask you something directly. Do you trade the same way after a loss as you do after a win? Most people do not. After a win, confidence swells and position size mysteriously grows. After a loss, hesitation creeps in and good setups are skipped. That emotional variability quietly erodes the repeatability required for compounding to work. Consistency in behavior is what allows consistency in results. Another point that often goes unspoken is that small edges require strong risk management to function properly. If your average loss is uncontrolled or your position sizing fluctuates wildly, even a statistically sound strategy will struggle. The edge is not just in the entry, it is in the entire process surrounding the trade entry. Position size, stop placement, trade management, review. Each piece supports the others. Remove discipline from any one of them, and the edge begins to weaken. There is also a psychological advantage to focusing on small, repeatable gains. It keeps the trader grounded in process rather than fantasy. When your objective is steady execution, you stop looking for miracles. You stop forcing trades out of boredom. You begin to respect the quiet rhythm of the market, the expansions and contractions, the clean trends and the messy ranges. And something interesting happens when that mindset settles in. You begin to notice that the market offers plenty of opportunity for those who are selective. Not every day, not every session, but often enough. The trader chasing big wins tends to overtrade and dilute his capital. The trader focused on small edges becomes more patient, more selective, more deliberate. Over time, that difference compounds. Of course, this approach demands emotional maturity. There will be moments when others appear to be making money faster. There will be sudden moves you did not capture. There will be trades that run farther after you exit according to plan. These moments test your discipline more than any losing streak, because the temptation will always whisper, maybe you should swing bigger. But the trader who survives long enough learns that consistency beats excitement. He learns that protecting capital during quiet periods allows him to participate when conditions truly align. He learns that steady growth, while less dramatic, builds something far more durable than occasional windfalls. Small edges also encourage better review habits. When your focus shifts from single big wins to repeatable performance, you begin studying your trades differently. You look for patterns in your behavior. You track execution quality. You measure risk to reward over time. The process becomes more analytical and less emotional. That is where real improvement lies. And perhaps most importantly, small edges reduce the emotional swings that destroy many promising traders. When no single trade carries excessive weight, the mind stays clearer. Decisions become calmer. The chart becomes easier to read because fear and greed are no longer shouting quite so loudly. This is the quiet path most do not talk about. The slow strengthening of skill, discipline, and capital through repeated, measured execution. Not glamorous, not dramatic, but very difficult to shake once it begins to work in your favor.